Okay, now that we have a strong understanding of how to chart supply and demand zones, in this video, we will be focusing on entering trades at these supply and demand zones, as well as how to identify a stop loss. It is important to understand that you should not just take a trade because price enters a supply or demand zone. Price entering the zone simply gives the setup for a potential trade, but you should look for confirmations that price has a strong chance of reversing out of that zone. In this video, we will highlight these confirmations. Let's go ahead and look at some supply and demand zones here on TradingView. There are quite a few different confirmations that we can look for when looking to trade a supply or demand zone. However, for each of these different confirmations, you are generally going to be scaling down in time frame to see how the price is acting as it approaches a zone. This, of course, has to deal with the fractal nature of the market, where reversals start with changes on the lower time frames from bearish to bullish or bullish to bearish depending on the reversal that is at hand. What this means is that if we are looking for a reversal going into, say, a 2-hour supply zone, then we would be looking for signs of reversals going into this level on the lower time frames, such as the 5 and 15-minute time frames, where price action would be indicating a reversal that transfers over to the higher time frames, which would then show those signs of reversal. So reversals will start from the lower time frames and move upward as time progresses. Let's take a look at this example here. We have a 4-hour demand zone, and we see that price is pretty much touching along this zone right here. And if we want to go ahead and identify an entry, we would be scaling down in time frames. As you can see on this 4-hour chart here, it's a bit unsure if price is actually going to continue through the demand zone or bounce off of it. So we'd be looking for signs of reversal on lower time frames, such as the 1 hour. When I move to the 1 hour time frame, it starts to become a lot more clear as to price becoming more staggering and stalling out at this level. And when I go to the 30-minute time frame and I just apply some trend lines to the consolidation that we're seeing here and this price staggering, you'll notice that we actually have a falling wedge pattern that has formed here. Now, this wedge pattern right here is a very strong indication of a reversal. And being that it is on the demand zone, this would be a strong confirmation to enter the trade if we can get a breakout out of this level. And as traders, we can utilize these lower time frames to get a better understanding of where our entry should be, since we would want the lower time frames to be showing signs of reversals rather than continuations going into supply and demand zones. If the lower time frames are showing signs of continuation through a supply or demand zone, then we would just not be looking to take a reversal trade there. Since reversals are more apparent on the lower time frames and build up to becoming more apparent on the longer time frames as price develops, using the lower time frames allows for more accurate and lower risk entries, since a stop loss would be a lot closer to entry. If we use the same time frame to identify an entry as we approach the zone, the confirmation of a reversal would become apparent far later in time as price develops. I mentioned in the charting of supply and demand videos that moves off of supply and demand zones are proportional to the time frame used to chart the zone. And this is, of course, going to be useful for identifying price targets. However, by using the lower time frames to identify price movements into the zone, we can get a much stronger entry point due to the fact that reversals start from the lower time frames and progress from there. Essentially, as time progresses and price develops, higher time frames will slowly add confirmations to enter a trade, but confirmations will generally start with the lower time frames. So in this example that we have been looking at, confirmations of a reversal were first apparent on this 30-minute time frame, and if we go ahead and look for a breakout here, you'll notice that we get a breakout that occurs right here, and just after that, we see a 3 white soldiers pattern that comes out of this breakout, which is a confirmation on the 1-hour chart as well. However, if we go to, say, the 4-hour chart, we don't see those confirmations yet because we have not seen that change in market structure. We would need to see a candlestick close above this level on the 4-hour chart for a confirmation to go ahead and take an entry there, as the trend would be breaking. If I go ahead and wait out for that, you'll notice that occurs on this candlestick here, which is far later than the breakout of where that wedge pattern happened on the 30-minute chart. And of course, if I go ahead and let this play out, you'll see that we did get a nice reversal to the upside and a strong move upward where profit could have been made. Now, do not be intimidated by these different levels of confirmations on each of the different time frames that we just went over, because the rest of this video will focus on the various types of confirmations that we can see on each of the different time frames. Let's start with strength going into these levels. If I move back here to the 1 hour chart, and we look at this wedge pattern right here, we want to see that directional strength is decreasing going into the demand zone. Now, one of the most effective ways to identify early signs of reversals is to look for divergences between price and relative strength going into these levels. More specifically, the relative strength index, or this indicator right here, also known as the RSI, is a very effective indicator that can be used to identify divergences. Divergences between price and relative strength occur when upside strength is decreasing as new highs are being made, or when downside strength is decreasing when new lows are being created. The divergence between the two occurs due to inertia from the previous move. Similarly to how a train takes a bit to fully stop after it applies the brakes, after an upside or downside move in the market occurs, there is still momentum from a move that continues pushing price before a reversal to the other direction is to occur. Notice in this example that we are looking at, as price is entering this 4-hour demand zone on the 1-hour time frame, the price is making lower lows here, here, over here, and even all the way over here as well. However, when we take a look at the RSI and identify a trend line to create the lows, you'll notice that we're actually getting higher lows for each of these different respective lows that had to do with price. Now, this would indicate that bullish divergence is occurring where new lows in price are made while higher lows on the indicator are corresponding with each lower low. Hence the name, bullish divergence typically leads to a reversal to the upside. We can look for bullish divergence on lower time frames going into the demand zone, and this bullish divergence is acting as confirmation that price is likely to reverse at the demand zone. Remember, the market is essentially a fractal where reversals start on the lower time frames and become more apparent on the longer time frames as time goes on. So the more time frames that show divergences going into supply or demand zones, the more likely that price is going to reverse at these zones, since there are more time frames agreeing on the fact that directional strength is decreasing going into these levels. On this example here, we already noticed that the 1-hour chart was showing bullish divergence. If I then change to the 2-hour chart, we then once again have bullish divergence, and even the 4-hour chart will show you that same bullish divergence. So now we have multiple timeframes all agreeing on price diverging into this level, which is going to give us very strong probabilities of that reversal here that we just previously saw. Now you might be asking, how do we use these divergences to identify an entry into the trade? Well, let's go back to this 1-hour chart here. There's a specific pattern that tends to accompany divergences between price and relative strength, and that would be the consolidation of a wedge pattern, which is what we have already identified. As we know, a wedge pattern in itself is a reversal pattern, whether that be a falling wedge that tends to reverse upward or a rising wedge that tends to reverse downward. We can identify these wedges by just marking the consolidation highs and lows with a trend line. If the trend lines are converging and pointing into the same direction, then you just have identified a wedge pattern. Notice here with the trend lines that I have already identified, the trend lines are converging, meaning they're becoming closer together, and they are both pointing downward. This, of course, would be considered a falling wedge, where price has a strong chance of reversing to the upside upon a breakout of this upper trend line, which we have seen here. Now, there's two ways to go ahead and play this. You can either see the divergence and enter at one of these lower trend lines that make up the wedge pattern and set your stop loss beneath the demand zone, or you can wait for a breakout above the upper trend line and for it to confirm by closing above the most recent touch on that trend line. So if I want to go ahead and identify the most recent touch, I would go ahead and notice that that would be at this level right here, where this candlestick touched this upper trend line, and that occurs at 3282.50. So with this green candlestick that closed above that level, just confirmed the breakout of the wedge, and I can go ahead and look to take a long entry there. And this time, the stop loss would just be at the pattern low. Now, for the close of the candle to be above the entry point, It has to be on the same time frame or higher that you identified the wedge on. So being that the wedge is pretty identifiable on both the 30 and 1 hour time frames, we can use the 1 hour time frame and just look for a candle close above this level. Of course, you could use a 30-minute time frame as well. However, the 1 hour time frame is going to give us that extra confirmation to go ahead and take a trade to the upside. Well, of course, we're going to go over how to identify profit-taking levels in future videos, but for now, we are just focusing on the confirmations to enter the trade. Let's take a look at an inverted example of this, where price is entering a supply zone. Take a look at this chart here where we have a 30-minute supply zone. And as price is looking to retest this zone, we can scale down to the 5-minute chart where we notice that we already have that bearish divergence. Notice we're making lower highs in relative strength, while on the price chart, we're actually making higher highs. So this would of course be bearish divergence. Now, if I go ahead and tack on a trend line to the bottom part, you'll notice that would of course be a wedge pattern where we have two converging trend lines that are pushing into the same direction, leading into the supply zone. This is going to be a rising wedge, and as we know about rising wedges, they tend to reverse to the downside. Now, you can play this the same two ways. The first way could of course just by taking the trade within the supply zone and setting a stop loss above when you see that divergence going into the zone. And the second way would be to wait for the breakout of the wedge pattern. So if I wanted to wait for the breakout of the wedge pattern, I would look for a candlestick close beneath the most recent touch, which is at 4041.25. And let's go ahead and watch this play develop and see how we would look to enter the trade. As you can see on this red candlestick right here that closed beneath this level, we'd be looking to take a short position here and setting our stop loss at the top of the wedge pattern at around 4050.50. Now let's go ahead and see what happens. And as we watch this move further develop, we see a very strong clean move. I couldn't even catch it all on the screen, but we see a very strong clean move to the downside where profit could be made, giving you a low risk, high reward setup. And as I mentioned earlier, we'll be going over profit-taking opportunities in future videos, but this example was more to show the power of using divergences on lower time frames to identify potential reversals going into supply zones. Let's take a look at this example here where we have a 1 hour demand zone and we are currently seeing price move into it. Just off rip, let's talk about the RSI here. We can look for strong bounces at demand zones by using the more common indications portrayed by the RSI. These more common indications that I'm referring to are overbought and oversold conditions in relative strength. The RSI tends to see a lot of movement between the levels of 30 and 70. When the RSI dips below a level of 30, like we're seeing here, or above a level of 70, like it is over here, this is representing extreme conditions in the market. Now, when the RSI is below a level of 30, this represents oversold conditions, where it is unsustainable for price to keep dipping at its current rate, and there's likely to be a bounce of some sort to the upside. Likewise, when the RSI is above a level of 70, this represents overbought conditions, where it is then unsustainable for price to keep rising at its current rate, and there is likely to be a bounce of some sort to the downside. As we are looking at this price chart here on the 1 hour chart, we're seeing that it is currently showing these oversold conditions inside the demand zone. This is indicative of price showing strong likelihoods of reversing to the upside. This in itself is a confirmation for an entry for an upside move in the demand zone, where a stop loss would of course be set beneath the demand zone. However, take a look at other time frames as we scale downward. Let's go to the 15-minute chart. On the 15-minute chart, we are also seeing an oversold condition. Now, when I go down to the 5-minute chart, we are once again seeing an oversold condition. Now, the interesting part is if we scale all the way down to the 1-minute chart, look what we have happening here. We have that oversold condition, but let's take a trend line to this. As we know, early signs of reversal start with the lower time frame. And if we go ahead and just mark out this small move that occurred right here, let's notice something interesting that is happening here. We have a wedge pattern that is accompanied by bullish divergence on the 1-minute chart. Now, The 5, 15, and 1 hour chart were each showing those oversold conditions, which was already enough to enter a trade there. But now we can look to get a very precise entry on where to enter this trade. Of course, we would place this the exact same way, pull out a horizontal line, and identify where the most recent touch was on the wedge. Now, if we look right here, we'll see the breakout actually occurs on this green candlestick here, and we can look to take an entry to the upside with additional confirmation with this candlestick close above this level, setting the stop loss beneath the wedge pattern. Now, if I go ahead and just play this out, you'll notice that we get a bit more of consolidation on the 1 minute chart, but then we start to get a nice little rise that occurs. Once again, we're going to go over exactly how you would be looking to take profit and where and when you should be looking to take profit in the future videos. But this was just to show you guys the fractal nature of the market, where all the timeframes were agreeing on a bounce occurring, and the 1 minute chart showed that bullish divergence to accompany it. Now, it is also important to notice that since divergence was only really visible on this 1 minute chart here, we would not necessarily be looking for a full-scale reversal to take place, as the play could always potentially be just a dead cat bounce, where it rises up shortly and then continues back downward. But since there were all those other indications of oversold conditions plus the 1 minute divergence, we could look for a bounce of some sort nonetheless for a fairly profitable play here. Let's go ahead and take a look at this 1 hour supply zone where price is currently within it. If we scale all the way down to the 5 minute charts, let's go ahead and take a look at what is happening coming into this level. Well, we'll see that new highs were made on each of these streaks right here. And if I add a trend line to compare each of those highs with the RSI, you'll notice that, of course, we have bearish divergence going on. So you can always just go ahead and decide to take an entry with that bearish divergence, set a stop loss above the supply zone, or you can wait for additional confirmation. Like if I go ahead and play out a couple more candles, you'll actually notice that we do get that confirmation right here. If you're looking at the 1 minute chart, this would look something like a double top. But here, if I go ahead and zoom in on this a little bit, you'll notice that we actually have a candlestick pattern here that can be used to identify confirmation for a reversal. Now, the confirmation that we're looking to see here is actually that of a bearish engulfing candlestick, where you would just enter just beneath it on a close below the level. But we're going to go ahead and talk about those later. But namely, notice what is happening here. We have that overbought condition going into the supply zone. After seeing that overbought condition going into the supply zone, it did pull back a little bit. But what I like to do when I see an overbought condition prior to a major level, such as a supply zone, then I would be letting price at least consolidate and see if it can push a little bit higher into that zone. Because what is that showing me is that if we can push higher into the zone, then we might see that divergence occurring on the RSI. The fact that that did happen in this situation gave us that extra bit of confirmation with the divergence, the higher highs going into the supply zone, and of course, this bearish engulfing here just to top it off. Now, if I go ahead and just let this play out, you'll see that once again, we get a very nice clean move off of the supply zone where profit could be looking to take place. So there may be an occurrence where price hits overbought conditions before reaching the zone and then just immediately break back downward without ever hitting the zone. And when that is to occur, do not fret, but rather wait for the next setup to come around and do not chase the play that is already in the midst of completing a fully developed move. Anyway, in this case, the RSI did reach that overbought zone prior to the zone and then continued to diverge as price moved into the zone. Also, you'll notice that we did not see a wedge pattern form into this zone with the divergence. If I go ahead and just identify some trend lines on this consolidation, they're not converging, moving into the same place. More of this would be kind of like a broadening top, but it does not have to be a wedge to see divergence occur. As you have seen through the different examples we have shown with the RSI, there are quite a few different ways to use it to identify an entry by scaling down in time frames and looking for confirmations for an entry. As we know with trading, nothing is for certain in the market, so it is always important to respect your stop loss with these trading styles, as no matter how perfect a setup may look, there is always the potential for it to become invalidated and move in the opposite direction than you anticipated. Let's take a look at another type of confirmation that can be used to identify entries in supply and demand zones. This type of confirmation has more so to do with candlestick patterns that form along or inside supply and demand zones. Essentially, candlestick patterns allow traders to identify bullish and bearish setups through the use of only a couple of candles. Generally, candlestick patterns will form through 2 to 5 candles, and they tell a trader a lot about the technical setup of a price chart. To get better at this type of confirmation, you will need to have a vast knowledge of the different types of candlestick patterns, and there are quite a lot of them, so what you can do is simply go to Google, look up stock candlestick patterns, and print out a few of the different types, so you can have them on your desk for easy reference when trading. There are a few that are quite frequent along supply and demand zones, and these are the ones that we are going to focus on here. Namely, the bullish candlestick patterns that we are going to be looking for are the bullish engulfing pattern, the bullish Harami pattern, and the bullish 3-line strike pattern. Likewise, the bearish candlestick patterns that we are generally going to be looking for are the bearish engulfing pattern, which was the pattern that we just saw in the last example, the bearish Harami pattern, and the bearish 3-line strike pattern. Of course, there are going to be other candlestick patterns that can be found and used for an entry along supply and demand zones, but these are generally the most common that we see. Here we are looking at a 4-hour demand zone. Let's scale down in time frames and see if there are any confirmations to enter a trade to the upside coming out of this zone. We go down to the 1-hour time frames. Let's watch and see as price approaches this zone. As we watch right here, we'll notice that the first time price came and tested this zone, it did get a bounce of some sort, but there was not necessarily that confirmation to go ahead and enter the trade. We have a near bullish engulfing candlestick, but notice these did open and close at the same level, so this can't be a bullish engulfing candlestick. And if we even scale down to, say, the 15-minute time frame, there are still no confirmations for an entry with just candlestick patterns alone. However, if we keep going to play this out, we'll see that price is retesting here on the 15-minute time frame. Now, look what we're seeing here. We have a 15-minute candlestick on the green side that is entirely within the red candlestick that was prior. As we know from that chart that we just explained, this would be a bullish Harami candle, and we can look to play this setup by entering on the break of the two highs, which would have occurred on this candlestick, and set a stop loss beneath it. Now, we have already seen how price developed, and we see a strong upside move. But if we go ahead and look at the 1-hour time frame that formed with this green candlestick right here, we'll notice that we actually get a 3-line strike pattern that occurs between these 4 candlesticks right here. To play the 3-line strike pattern, simply wait for a break of the high over here and take an entry and set the stop loss beneath the lows. But once again, we were able to see those signs of reversal on the lower time frame at the 15-minute chart, and then it became more apparent on the 1-hour time frame. And if I continue to play this out, you would notice you get an entry on this green candlestick here for that 3-line strike pattern, and then it continues up and creates a nice move to the upside. So, in general, you'll pretty much be sifting through the different time frames to identify those signs of reversals to find your entry, and by the way, be objective when you are looking for these patterns. If you have to turn your head sideways and squint at your computer screen to see a pattern, then it is likely not there and you are being biased where you're better off just waiting for confirmation to enter the trade. Just make sure you are being objective in your analysis. Okay, let's go ahead and take a look at this 30-minute demand zone here, where price is currently testing this level. If we go ahead and scale down in time frames to, say, the 1-minute chart, you'll notice that we're actually getting a bit of a wedge pattern going into this level. You'll see that we have the wedge right here with the lower trend line and the upper trend line here that converge and point both downward. So if we're looking to play this wedge pattern, we would look for a breakout outside of this level right here. That confirms the wedge pattern, and we would take an entry to the upside. But also, let's go ahead and play this out on the 3-minute a little bit and see what happens. Well, we actually get something quite interesting. Not only did we break out of that wedge pattern, which if I go back to the 1-minute chart, you can clearly see on this green candlestick right here that broke over the recent level. But if I go back to the 3-minute chart, that wedge pattern breakout also created a bullish engulfing candlestick right at the demand zone. And as we know, you just take an entry with the break above this level, set the stop loss at the low right there. And anyway, we did get that 3-minute breakout there, but let's go ahead and take a look at the 5-minute chart as well. The 5-minute chart, we have yet another candlestick pattern that just formed, and this would be the bullish 3-line strike pattern that we just saw in the previous example. Once again, the entry would be with a break above the candlestick pattern high and stop loss at the pattern low, which is again going to be the same stop loss as the other two patterns. Now, as we watch this play out, there's a very clean move to the upside, and that just goes to show the power of using candlestick patterns to identify entry points for a reversal off of a supply or demand zone. But this example also really exemplifies the fractal nature of the market, where signs of reversal are first visibly seen on the lower time frames and slowly make themselves more evident as price develops on the longer time frames. As you can see from the past couple of examples, candlestick patterns are very powerful for identifying entry points along supply or demand zones. Here we are looking at a supply zone on the 15-minute time frame, and price is looking to test it right here. So if we scale down to the 2-minute time frame, we'll notice that there aren't many signs of a reversal just yet. We do get a quick bounce down off of that first test of the level, but there was no confirmation for us to go ahead and enter the trade just yet. As we continue letting this play out though, notice what happens on the second time we enter the zone. We get a bearish engulfing pattern that confirms with a break below it with this candlestick here, and we can ride that to the downside. And of course, the stop loss for this specific pattern would be set above the high of the two candlesticks that made up the pattern. Now, the fractal nature of the market is acting here once again, because if we go to the 5-minute chart, notice what we have here. We have that bearish 3-line strike pattern where an entry can be taken just below that. So we have the 2-minute chart giving us that confirmation with the bearish engulfing within the supply zone. And then just off of that, we get a nice 3-line strike pattern to the bearish side, where if we let this play out, you'll notice we get a pretty nice and clean move to the downside, where profit can of course be taken. And guys, by the way, these candlestick patterns happen on every time frame, so it is just important that you watch out for them as they give very strong clues about the potential future direction of the market. Anyway, here we have a 10-minute supply zone, and let's go ahead and just watch the price approach this zone on the 10-minute time frame, which is where we identify the supply zone at. When we go ahead and do this, we'll actually notice that we get a bearish engulfing candlestick that occurs on the same time frame that the supply zone was identified on. Now, as we know how to play this, you just enter with a simple break beneath the two candlesticks, set the stop loss at the high over here, and if we just go ahead and let this play out, you'll notice that we did get a pretty clean move to the downside from there, where profit can be taken. Okay, so this next type of confirmation for entering a trade going into supply or demand zone is going to involve volume analysis. More specifically, we are going to be using the AlgoVision volume indicator to better understand how buyers and sellers are acting when we approach a supply or demand zone. Recall that a supply or demand zone moves price due to the imbalance between supply and demand or buyers and sellers. Therefore, when price is retesting a supply or demand zone, we should be looking for a decrease in buy or sell volume respectively. Because if buy volume is increasing going into supply zone, then there may be enough eager buyers to outnumber the sell orders that are left there unfilled. Likewise, if sell volume is increasing going into a demand zone, then there may be enough eager sellers to outnumber the number of buy orders that are left in that zone unfilled. So if we are looking to play a reversal off a supply or demand zone, we would like to see the respective buy or sell volume decrease going into that zone there. That way, when we do enter the zone, there's still going to be that imbalance of supply and demand, and price will have stronger chances of reversing at this level. If the opposite is to occur, where there is an increase of eager buyers going into the supply zone, or an increase of sellers going into a demand zone, then those eager buyers or sellers will have enough strength to push through the zone and potentially validate it. Let's take a look at some examples of this to see what we mean. Looking at this 1 hour supply zone here, let's do some volume analysis as price retraces into the zone. With the AlgoVision volume indicator, we can see how much buy and sell volume makes up each candle. Buy volume is of course going to be represented by the green portion of the histogram, and sell volume is represented by the red portion of the histogram. What we are looking for going into the supply zone is for buy volume to be decreasing and ideally be at its lowest while it's at the supply zone. So scaling down to the 30-minute time frame here, you will already notice that there is a decrease in overall volume, the combined amount of volume between buyers and sellers. However, notice that as we lead up into the zone, the proportion of buyers and sellers is ever so decreasing as we get closer and closer to the zone. Now, if we play this out, and notice here, the candlestick that actually was in the zone, we have the lowest amount of buy volume, and we see an increase in sell volume. Essentially, this is pretty much exactly what we are looking for. Buy volume to be at its lowest while we're in the zone, and for sell volume to be increasing, and buy volume decreasing going into the zone, sell volume increasing going out of the zone. Now, as we watch this play out, we'll see a decent retracement back to the downside, where profits can of course be taken. Okay, now let's look at this with the demand zone. Here we are looking at a 5-minute demand zone that just formed. Now, if we scale down to the 1-minute chart, now that we're on the 1-minute chart, let's watch the volume over here as we are approaching this zone. Look at the candlesticks that lead up into the zone, these 3 candlesticks specifically. There is a decrease in the proportion of sellers, while we see an increase in the proportion of buyers, and that is represented by the decrease in red and increase in the size of the green. Now, this candlestick would act as confirmation here to go ahead and enter the trade, because not only do we have that decreasing sell volume going into the level with that increasing buy volume, but we also have a 3-line strike pattern that just formed here on the 1-minute chart. Now, as we watch this play out, you would have confirmation to go ahead and enter the trade, and we do get a pretty solidly decent move to the upside from there, where of course profit could look to be taken somewhere in this range. Okay, here is a 15-minute demand zone. Let's scale down in time frames and watch volume as the retracement to this level occurs. If we go down to the 3-minute time frame, let's see and watch as volume moves as we approach this zone. So the volume analysis here will pretty much deal with these candlesticks that lead up into the zone. Notice smaller and smaller proportions of sell volume going into the zone, increasing amounts of buy volume. And on this red candlestick here, we actually get a overpowering amount of buy volume. So this would be confirmation to go ahead and enter the trade with this volume analysis here, entering on this next candlestick here, and setting the stop loss beneath the overall demand zone. Typically, when you see this flip in proportion where the sellers were in control here, and then now we see that the buyers are in control of these couple of candles here, this is a very strong indication and even further confirmation to go ahead and take a trade to the upside, giving you a setup that has relatively low risk and far greater reward. Now, as we watch this play out, we get a pretty strong bounce off of this level. And as we just saw that play out, we did just see a pretty nice bounce off of the level where an upside move did occur. Okay, let's look at one more example here with this 30-minute supply zone. This setup has a pretty interesting example of volume analysis going into a supply zone. We scale down to the 2-minute charts and take a look at how we're moving into this zone. Let's play this out. Notice With this move into the zone, we actually see an increase of buy volume going into the zone. When this is to occur, I would not look to enter a trade and rather wait to see if there's going to be another retest and see if there's decreasing buy volume there, or just not take the trade at all. Now, as we watch this play out, notice what is happening here. At this point, on these candlesticks that lead up into the retest here, notice what is happening with the proportions of buy and sell volume. First, there is a decrease in overall volume going into the retracement of the level, which is already telling us that price is beginning to stall on this retest. But take a look at these three candlesticks leading up into the zone. On this first candlestick through the third one, there is a drastic decrease in buy volume between the three candlesticks, with each consecutive candle having less buy volume. Now, on the candle that actually does touch the zone, there's an overwhelming amount of sell volume that now gives us the confirmation to go ahead and enter a short position with a stop loss above the zone. Now, as we watch this play out, we do have a much cleaner move this time to the downside, where profits could be looking to take place at. So, we went over a couple of strong confirmations to use for supply and demand zones, but remember, if there is no confirmation, it is better to sit on your hands and not take the trade. It is best to wait for a confirmation to enter a reversal trade, as those trades have the highest probabilities of success. Anyway, that will do it for this video on entering trades in supply or demand zones. In the next video, we will take a look at how one can identify a profit-taking level for a trade where they entered in or at a supply or demand zone.